we thought there is a space there for us to provide this SMEs with devices which can enable them to accept card payments without the burden of having to have a minimum level turnover, which is difficult for SME, and also not having to lay out money in terms of a financial outlay to buy the machine or whatever. I mentioned PAYable started 10 years ago. It was a startup started by two enterprising young men, Sujit Subasinghe and Johan Vijayasrivardhana. They were initially incubated by my friend Tony Singaraya, and after a year or so of incubation, Tony came to me and introduced the team. I have always been interested in technology and how technology can drive efficiencies in business while also enhancing financial inclusion. So when Tony brought these people, basically it started as reverse engineering what was then known as the square in the US. I remember when I was traveling in the US, and there was this guy in the cart selling hot dogs and trying to buy one of them. It's up $2 something. And I didn't have change. And then this guy produced this square, and I gave my card and they swiped it. And I thought this is an excellent way in which there is financial inclusion. You don't have to worry about change. So when they came to me and talked about this, I saw this potential that was there for PAYable. So I joined up with Tony and supported them financially. And then I introduced my friend Rajendra Tyagaraja, who's now the chairman. And with that, it took off. We had two more significant shareholders who joined us. One was Shan Shanmuganathan and Jihan. And so that's the beginning. The idea behind PAYable was that, see, at that time, credit cards were basically accepted by the major stores because the banks who were providing the credit card machines required certain minimum level of turnover. I remember it was $1 million a month or something at that time, and which of course was beyond the reach of the small scale SMEs. And we thought there is a space there for us to provide this SMEs with devices which can enable them to accept card payments without the burden of having to have a minimum level turnover, which is difficult for SME, and also not having to lay out money in terms of a financial outlay to buy the machine or whatever. So we came up with this concept of the device at that time, which initially started with Visa, Master, and then we added on an MX as well. But now, of course, they have transitioned to accepting any type of card. The key change that we tried to do was that it was a different business model. We gave the device free to the SME merchant, and we took 1% of the MDR, which is the percentage that is charged on either paid by the customer or the merchant for payment by credit card. It was a little capital intensive decision because we had to buy the devices and hand it out, and then the recovery comes from the MDR. And being small and medium scale enterprises, you don't have huge revenues at that time. So the recovery takes time. And that's why you'll find that even now, PAYable is a fairly heavily capitalized company. We have close upon 700 million in capital. And that's largely because of the investment into the equipment that we gave free. And that helped to take better take up by the merchants because they didn't have to pay outlay to get the machines. They only had to have the business registration and all the other forms, the KYCs, and then they had a device which they could accept credit card payments. So even the mom and pop store or the wayside kade could accept credit cards. And to us, that was, apart from the business, it also gave us satisfaction that we were contributing to better financial inclusion in the trading space in Sri Lanka. So that was the original concept. It was not just a business, but while we were, of course, looking for returns, we were hopefully contributing to better financial inclusion, particularly in the SME, which, as you know, in Sri Lanka, they contribute almost 60-70% of the business. See, if you look at the founders, the founder investors, apart from the two founders who came up with the technology, that is Tony Singaraya, myself, and Rajendra Tyagaraja, who came in and now is the chairman. We're all chartered accountants. And by training, to us, governance is something that is instilled in us. Systems, controls, and governance are instilled as part of our learning. Right? So it came naturally to us that when we came together to put PAYable, that we laid a lot of emphasis on getting the governance right. Lots of startups fail because they don't give enough attention to the governance space. They put a lot of emphasis on the technology and getting the business model, and then the structural defects that comes from weak governance eventually leads them to failure. If you have a good, strong governance, that can help to withstand the challenges that startups are bound to face. And that's why we were very keen that day one we will have strong governance, strong systems, and strong processes in place. You see, the problem with SMEs are largely a cash business. So they sell for cash, right? And anyway, Sri Lanka still, I think almost 70-80% of business is still done in cash. And that affinity of cash, or the what they used to, was actually the biggest drawback. Because anytime they prefer to get cash, because they always thought of cash as something superior to anything else. And then they also think in terms of the MDR. If the merchant accepts that out of he sells for 100, he gets maybe 97.5 in cash, the balance goes to the card company. So these guys work on small margins. So obviously, when people go to a semi-customer, even if he had a machine, what he normally tries to do is sell cash. And if the customer says, oh, I don't have cash, then he produces a machine. So our device was always a second option. He tried to sell for cash. If people get cash, it's fine, he collects the cash. But if people walks away, then he doesn't want to lose the business, and therefore he produces the machine and accepts payment. Now that was a challenge, because you see, the way we have spent on the device and we need to recover through the MDR. So if they don't do a certain amount of volume of business, let's say if they do 30,000, we will get 3,000, 1%. So if they don't do that, the recovery we get from the merchant is less, and obviously the time taken to recover the cost is high. That's one. Secondly, of course, also, when everybody wants to get a device, so we had a large number of merchants who took on, but not all of them were active. We had a system of aggressively monitoring the usage. And if those who were not using, we took the device back, because we never sold it to them. We gave it free. And we said that if people must do a certain minimum amount of turnover for the month using the machine, and if they don't, what we introduced something like a cover charge. They'll have to pay the rental, which was a minimum. So if they did transactions above the minimum, then no rental was charged. So that was a way of trying to incentivize them to use the machine. With greater awareness, greater digitalization, I think we have something like more debit cards in this country than we have people. I think last count we had something like 24 million debit cards for 20 million people. But with the greater use of card, people also start not carrying too much cash. And card usage, particularly debit card, where credit cards are given to people whose credit history is looked at by the bank. But get debit card, everybody is entitled to a debit card as long as you have money in your account. So that, I think, drove greater level of card usage. And that's why we were particularly pleased when we had recently crossed 100 billion in transactions running through our system, which I think is a landmark in term for a startup, which only started 10 years ago. See, when we started the whole concept, we were doing on servers. The whole software solution was based on servers. So we had in banks, servers in the banks that we were working with, and servers in our office. But with the cloud adoption worldwide, we have moved a solution to the cloud, which means our processing is backed by the cloud security and all the disaster recovery that comes with the cloud, which is a big benefit. We don't have to spend on that other than the subscription. With the cloud, our solutions work on the cloud. So, for example, if we want to launch a PAYable in another country, as long as we have a partner who will invest in the mesh devices and the marketing, the processing of all the transactions in that country can still be done in Sri Lanka. We don't have to go to that country and put computers and nothing. The solution that is there in the cloud can process transactions in any number of countries. All we need is to have enough cloud capacity. So that gives us the advantage of having a solution which we can either franchise or co-invest in areas where digital adoption has not been as great. For example, now countries like Africa is an area we're looking at. There is a lot of demand for digital card usage, QR, because they are behind us in terms of adoption to digital payments. And we believe that with our solution, right, which runs on the cloud, we can easily extend to servicing more markets than Sri Lanka. And that's where the value add will come. Because Sri Lanka is a small market, we're talking of 20 million people. But if you look at Africa and some of the other countries, you have bigger market, larger number of people, and the potential for upside growth is very high. So that's where we think PAYable's growth will come in the next phase. We are working very actively. Lots of inquiries have been made of PAYable. We have had lots of discussions, and in certain areas we are, shall I say, much more advanced in a stage of investments into those areas. So we are convinced that in the next short period of time, PAYable will extend its footprints beyond Sri Lanka. Good question. You see, the government has embarked on a digitalization drive, and I think rightly so. We have been talking about this for some time, but I think this government has taken this whole issue by the scruff of the neck and pushing it along. Towards this digitalization drive, I believe fintechs like us have a role to play, because we provide the channels or the means by which people can transact business without cash, whether it is cards like we do, or QR payments, or bank transfers. All of these are means by which people can effect transactions without resorting to cash. But while we have these institutions, the banks have doing their part, the fintechs are doing their part, it is also important for the government to take certain key policy decisions. In India, for example, you can't make cash payments more than 50,000 in cash. And beyond that, you have to use bank transfer, card, or any other digital payment mechanism. In Sri Lanka, all we have is a provision in the Inland Revenue Act which says that if you pay more than 500,000 in cash, that expense will not be allowed in arriving at your taxable profits. Now, the problem I have is that the guys who make more than 500,000 in cash are often not taxpayers at all. So this provision has no value because the people who are in the formal system anyway don't use cash to make payments. Now, I lead a couple of companies and I sit on the boards of several companies. We won't permit anybody to make payments in cash. That provision that the Indian Revenue Act, I think, is actually toothless because it doesn't mean anything because the guys who make those payments are not in the tax net. What I think the government should do, and I have been advocating this in several areas, is that government should, like what India has done, should say, for example, no payments should be allowed more than 100,000 in cash. That will force people to use digital channels to make payment. And the advantage of that is that all of these payments come into the fiscal space of the country. And automatically you will find that the economy will grow, the greater level of compliance level will grow, and everybody contributes a fair share to the growth of the country. While fintechs, banks, and others do their role in trying to support digitalization, support inclusion, and support economic growth, you need, on the other hand, the government to set in place certain key policy decisions which will facilitate greater inclusion, greater fintech use, and therefore bigger or more attractive growth for the company. In conclusion, we believe at PAYable, we have come a long way from the 10 years that we have started off with a few people around. We have now a nice office with lots of staff working, trying to go into foreign markets. I think it's a long journey, a journey with a lot of sweat and blood. We have the ups and downs. We have, like any startup, you'll have the obstacles. But I'd like to conclude by saying that, there's a saying that we all say that when the going gets tough, the tough get going. And that's how I would put PAYable's journey so far has been.